So welcome and thank you all for joining. We think this is a very important topic. I'm looking forward to going over in some detail a couple of topics. My name is John Silver, and I'm a managing director at Deaglo in the Sales and Marketing Group. And as I mentioned, we think we have a very important and relevant topic here, which is how to hedge investments with long holding periods, particularly around FX and collateral management. I'm going to be joined by two of my colleagues today from Deaglo, Matheus Zani and Daniel Porto, and they're going to kind of go over the real guts of the presentation. But I want to take a look at the agenda here first. As you can see, these are the topics we're going to cover, and then we're going to have Q&A at the end. So I want to also now tell you a bit about Deaglo on the next slide. And you can see that Deaglo was founded in 2019. We're a fintech firm that offers FX risk management solutions across a broad range of scenarios and institutions. And we feel we're supported by the best FX minds out there, particularly Matheus and Daniel. Now let's move on to the next slide. As you can see here, Deaglo is very proud to be working with some of the largest firms in the world who are kind of defining what we're doing and how we're doing it. And we become essential to these folks as they manage their FX risk going forward. Now we get into why FX risk matters. Very important. This slide is super interesting to me. You can see there's a wide disparity of performance in the chart on the left in terms of the MSCI Property Index calculated in a variety of currencies. This wide disparity in performance highlights the considerable impact that FX fluctuations can have on investment outcomes. We think this is why it's important to look at our platform, our tools, and our expertise. The next slide shows, again, why foreign exchange matters. The last slide was backward looking and historical, but investors, we feel, going forward may face even greater risks as time goes on. You can see the 12-month historical vol in the right-hand table with Chilean peso, Colombian peso, Argentine peso all at or near 20% volatility. We think this probably stays elevated for quite some time and presents issues that all managers need to look at, understand, and hedge. The next slide talks about currency movements and risks, and this is going to be an important part of the presentation. There's obviously a range of influences that affect exchange rates. I'm sure most of you are familiar with all of these, but they're important. Economic growth, structure of economies, trading relationships, inflation, interest rates, capital markets, and sentiment expectations about all the drivers mentioned above. There are a number of key theories that underpin expectations about currencies, including purchasing power parity, mean reversion. I think that these are important things we want to look at, and Matheus and Daniel are going to talk about them. At this time, I am going to turn it over to Matheus, and he is going to lead us through the next section of the presentation.
Thank you very much, John. Today, I'll be discussing two theories: purchasing power parity, well known as PPP, and mean reversion. Let's start by talking about PPP. With inflation rates at all-time high in recent years, many asset managers have inquired about the impact of inflation on exchange rates. In response, we conducted a study on the PPP theory, which explained the movement in exchange rates between two countries' currencies by changes in their price levels, which are essentially changes in inflation rates. According to PPP, the exchange rate between two countries' currencies is equal to the ratio of their price levels. Therefore, the theory predicts that a rise in the domestic price level will lead to a proportional currency depreciation in the FX market. Similarly, PPP predicts that a decrease in the domestic price level will lead to a proportional currency appreciation. In this chart on the right, we plotted the Brazil real rates and the PPP rates. US inflation is measured by US CPI urban consumers, and inflation in Brazil is measured by Brazil IPCA, IPCA in Portuguese. Although there is a reasonable long here 10 years, PPP has performed poorly in recent years, while it held approximately between 2012 and 2014. The PPP rate continued to remain stable between 2014 and 2022, while the Brazil real depreciated dramatically. What is the conclusion here? This suggests that the changes in inflation levels tell us little or nothing about the exchange rates movements. That said, despite the common belief among infrastructure and real estate funds that their revenues are indexed on inflation and therefore not exposed to currency risk, it's not entirely true. So move on to the second theory, mean reversion. Uh, Mean reversion is a theory that suggests that the prices and returns in financial markets tend to move toward their long-term average over time. Uh, in the context of FX markets, mean reversion theory implies that when a foreign exchange rate deviates significantly from its historical average, it's likely to eventually return to that level. That said, some fund managers usually say that there is no need for FX hedging because rates will return to the entry level. There's no currency risk, no need for protection. But unfortunately, asset managers hoping that it will happen, it is a naive approach, or in other words, a hedging the sun approach that will end in losses. We did a simple survey using Latin currencies such as Colombian peso, Brazilian real, and Chilean peso. And we can see that there is a persistent multi-year trend, as you can see in these three charts on the left. Uh, Therefore, it's a very naive to assume a mean reversion mechanism for emerging market currencies. Move on. We just saw that both theories explain very poorly the foreign exchange over the long run, and asset managers shouldn't rely on them to manage currency risks. That said, there are at least two hedging approaches that can be implemented in the long-term exposures. The first one, layer hedging approach, and the second one, rollover approach. Both of them have their own features, but basically, layer hedging seeks to minimize currency risk. A layer hedging strategy consists of hedging fractions of the FX exposure before the effective maturity, while the rollover approach seeks to fully eliminate currency risk. A rolling strategy consists of hedging the full amount of the FX exposure before the effective maturity through short-term hedges. You might be wondering, which one is the best? What is the best approach? Our experience says that a hybrid arrangement is the best choice. This hybrid approach has proven to be much more successful for long-term investments cash flow. So let's take a look at potential hedge strategy considering a real cash flow. In the blue table on the left, you can see the real cash flow used for the exercise here. This cash flow is a USD loan that a US credit fund will lend to a Mexican company. There are 4 deployment dates, as you can see: June 2023, December 2023, February 2024, and April 2024, and their respective maturities, which will be a bullet repayments to the maturity. For this cash flow, we put together a hybrid strategy for each one of the deployment flows. According to the client risk profile and previous value to risk analysis, we decide to hedge in the first layer 50% of the exposure on June 23 for 12 months out, and then roll it in June 2024, and then again in June 2025, in order to match the repayment flow in June 26. The second layer will be placed on a quarter later in August 2023, but now only with 25% of the exposure, and also rolling it twice until June 2026. Finally, the third layer will be placed in November 23, following the same mechanism described previously. So as you can see, we are using both approaches here, layer hedging and rolling approach. This arrangement is just for the first deployment, as I mentioned, for the deployment that will occur in June 2023. But for the following deployments, we can use the same arrangement or rerun the analysis to identify the best tenors and ready ratios. In general, this type of hedging arrangement is quite useful for asset managers since it offers versatility and brings a lot of flexibility. For example, uh, cash flow is never fully hedged, allowing the client to adjust the forecast for many months. Second, hedge ratios and tenors for each layer can be adjusted up or down. Third, each of these layers can be implemented with a different instrument, either in EDFs or options. So as a result, adopting this hybrid approach, we can expect to achieve something like this image, where you'll be reducing the volatility of the currency over the longer run. Again, we will not be able to completely remove the currency risk, but it will be reducing substantially the volatility of the currency in order to deliver much more stable returns to our investors. Now, you might be wondering about the derivative instruments that we need to use. A number of instruments are available, including currency forwards, NDFs, options, swaps, and so on. Overall, we need to take into consideration the costs, the performance, the availability of each instrument. In particular, the availability component is quite important for us because we need to make sure how far we can go when designing this hedging arrangement. I'll give you an example. For the Brazilian market, we cannot hedge 3 years out because we don't have neither any EDFs or options with the maturity for 3 years. So we don't have liquidity in the market. So we need to use 12 months or maximum 18 months to hedge this exposure. Okay? The same occurs in Peru and Mexico, in overall in the emerging market economies. So the lack of liquidity is ensured that you need to take in consideration when structure these hedging arrangements. So in order to expedite the decision making, in order to expedite the decision-making process to choose the hedging instrument, our technology allows our clients to identify which instrument will reduce the negative impact of the 40 points the most, protect against the tail risk, and allow the furthest upside participation. You can see this image on the left is an image from our platform. Okay, it's quite friendly user and very fast to run analysis to identify what is the best hedge instrument. So again, through our platform, you can easily identify what is the right hedge instrument for each layer and for each row trades. Now, one very important question: how much of the exposure to hedge? I think every single time when I jump on calls with my clients or other asset managers, they ask me this question: how much of the exposure I need to hedge? Unfortunately, the answer is not straightforward because it depends on a large number of variables, including the capacity of the manager to forecast the cash flow, the client risk profile, the hedging cost, and so on. But basically, the hedging can be done on total returns, NAV, the income flow expected, dividends, interest payments, and so on. Here at Deaglo, we run tailor-made analysis to identify the optimal hedge ratio for your cash flow, matching your risk profile and expected total returns. So we deliver risk adjustment returns to our clients. I want to here discuss some lessons that our team learned working with asset managers across emerging markets and developed markets in these last years. What is, I believe, be very important to highlight here. The higher the currency risk, the higher is the hedge ratio. Second, in particular for private equity funds, the hedge ratio tends to be smaller in the early and the middle stage of the investment, it tends to increase as the fund cash flow becomes more evident. Then the more predictable the investment cash flow, the hedge ratio tends to be higher in the early stage of the investment life cycle. And finally, when the hedging cost is higher, fund managers tend to reduce their hedge ratios. Uh, Finally, uh, through one of your tools, we enable our clients to assess the potential hedge impacts on the performance of the fund under different market conditions. For instance, changes in the currency volatility and the interest rate differentials. Right now, where we are discussing globally about the interest rates for each country. For instance, we have the Federal Reserve discussing hikes. Then we have in Brazil and Colombia and Mexico, their central banks discussing cuts in their benchmark rates. That's very important to analyze the hedge strategies over these market conditions. So we have the tools, we have the technology to run this analysis quite fast and very accurate. So again, we can evaluate different hedge strategies, approach, hedge ratios, considering their impacts on the returns of the fund. From me, that's it. Now I want to turn the floor over to my colleague, Daniel Port, that will be discussing collateral management. Thank you very much.
Thank you, Matheus, and hello everybody, and thank you very much for assisting to this webinar. When engaging in long-term hedging programs, it is important to establish a robust and a strong FX infrastructure in order to ensure that you can execute these hedging programs in an efficient fashion. The FX derivatives will always provide you the protection against the currency devaluation. So they will be actually giving you the desired protection. But the collateralization of these derivatives is very important, especially because when it comes to illiquid fund structures, like in private equity or private markets in general, given their dynamics and how they operate, the liquidity requirements can be very a big challenge for these managers. And therefore, having a strong infrastructure is going to help reducing the amount of margin calls when your hedges go out of the money. Because as we are saying, like we cannot control that the hedges are going to be out of the money if you're hedging, you're just trying to remove risk off. And it's important to ensure that the partners that you are executing these hedges with are providing you the facilities that cover these requirements. So in order to achieve a robust FX infrastructure, a diversified panel of providers make a lot of sense. Therefore, engaging multiple counterparties is going to give you like a better view of the market. It's going to give you a better sense of what is really offering out there. And you can compare and have a better approach to diversify as well the counterparty risk per se. However, it is important to understand that when you have multiple providers and you are allocating trades across the board, it's important to define very well a best execution policy, so that you can prove to your investors that you're always using a standardized and emotion-free approach. And there are basically two routes in which managers can go into allocating and having this approach. One of them is best price, but when managers focus a lot on best price, it means that you're going to have a higher collateral requirements for your hedging program. But this is of course going to give you competitiveness in the pricing that you're receiving. If you're a fund manager that has liquidity constraints and your priority or KPI is to improve liquidity optimization, then you will prioritize having lower collateral requirements to your hedging programs. But this will increase the pricing that you will be receiving because there will be a credit element to the pricing of your facilities. But this will help you minimize the collateral posting that you're seeing. Thank you, Matheus. Can next slide. So as we're saying, the collateral, when constructing a diversified panel of providers, the negotiation of credit lines to avoid posting margin is very important. At Deaglo, we created tools and we have like different resources that can help you, driven on the type of strategy that best fits you in terms of protection and participation. We can also help assess what are the liquidity requirements of that specific exposure, using this, taking into consideration the intricacies of each derivative, as they can be NDFs or forwards, or they can be options or option structures. And this can help as well, like first having a note about what is that really that credit ask that I'm gonna be providing to my partners, and as well as helping you negotiate with counterparties in a better way. What are the best, what are the terms that makes the most sense in order to optimize the liquidity at the fund level, really. The approach in which you can move on to a hedging program, it's also very important. Next slide, please, on this. Because it's not only like when it comes to hedging execution or the deployment of the hedging program, it's not only, and you're constructing like the FX infrastructure, it's not only about who am I hedging against, but it's also about like where am I hedging from. And therefore, the fund level approach, whether you're doing the hedging program from a fund level perspective or from a deal to deal level, it's a completely different conversation in terms of counterparty risk. And of course, the whole other dynamics and operations that can be done. So for example, main differences that you will find is that, for example, in terms of onboarding, if you were to deploy a fund level hedging program, you will most likely be facing the LP entities of your fund or the master fund, or you will have like a specific well-made hedge code that will have like the support from there. This will help you first do a clear beneficiary owner and a direct due diligence on the LPs and who are the investors behind it. And will also help you just execute one single onboarding for a full fund level structure. So you have a fund that you're planning to be alive for at least 7-8 years. Just a single onboarding will help you to have like all the requirements that you need to deploy this strategy. A very different approach, we will be like going into the deal level hedging, which we will be looking into onboarding or facing your counterparty against the SPV that is holding a specific asset. You need to understand that the credit worthiness of those specific vehicles is not the same as if you were facing directly the fund or the LP. And this changes a lot of the conversation in terms of like doing the KYC and doing like the overall inspection of the fund. And also you will be having to execute other kind of guarantees of extending different ways so that you can get the counterparties comfortable with providing you the credit that you are looking to do. For instance, in instance, for example, when we're looking into the fund level hedging, we won't see that the credit worthiness is going to be way higher, so there won't be no guarantee needed in any case. And you will also be more eligible to have credit intensive products. And for these credit intensive products, I mean, for example, very, very good products like HRRs, which are historic rate rollovers, which, for example, allow you to bring the ongoing mark to market into the long term, so that you can really help managing that affects impact on the liquidity requirements. And these are things that if you have the correct setup of where you're hedging from, you can have access to this type of products that will help you give the protection and will help you in terms as well of the liquidity, of taking care of the liquidity of the fund. As well, the fact that on the deal level hedging, the credit assessments are not potentially as attractive. You will see that you're going to have steeper markups and in pricing, and most likely you're going to be constricted only to trade vanilla products that are quite generic, when especially you need a strong credit solution to optimize the overall operation of the fund and being able to comply with the KPIs. That will be kind of my 2 cents.
Thank you very much, Daniel and Matheus. Excellent work. I just wanted to review a couple of the key takeaways here. You can see the list, but I think it's very evident that FX risk matters and can materially impact performance and IRR. So I think everybody, all aspects of the investment business, need to take a look at FX. And as Matheus told us, PPP theory does not really hold in the long run for most EM currencies. So we need to be more creative in our thinking and come up with new and interesting hedging strategies. FX rates can be mean reverting over long periods of time, but not always the case. So again, we have to take that into account when we put our FX hedging strategies in place. For longer holding periods, we have found that the hybrid approach, layered hedging and rollover, is what we have seen to be the most successful way to handle this risk. And as Matheus mentioned, the hedge ratio tends to be smaller in the early and middle stages of the investment life cycle and tends to increase as the fund inflows and outflows become more evident. So that is kind of what Matheus talked about. On Daniel's side, the collateral management matters as well. It can materially impact IRR and the performance of your funds. We firmly believe and want you guys to know that we're available, and Deaglo has the tools and expertise to help manage these risks over very long holding periods. Excuse me. I guess the last slide for me, if we move forward. Yeah. So this is my contact information, Matheus' contact information, Daniel's contact information. We really thank everybody for joining us. We're going to open it up for questions in a minute. We also will distribute the presentation after this is done to all your emails. So that's something that you can look at. And we really want everybody to know, feel free to reach out to any of us. We're available, we're hands-on, and we want to be receptive to everybody's needs. The last thing, as I said, I want to thank you all for joining us. We're going to be doing future webinars in the FX space, and we would love feedback from all the participants here on topics, format, etc., things that you guys would like to see us talk about. So if you don't mind, we're going to send a survey out after this, and please fill out the survey, and that would be something that would be very helpful to us, and it would be most appreciated. So on that note, I would open up the floor for any questions for myself, Matheus, or Daniel, and thank you again. Anybody can feel free to jump in. Okay.
Or feel free to ask any question through the chat.
Yeah. Okay, well, if we don't have any questions, thank you again, and we look forward to speaking with you guys in the future.
Thank you, everybody.
Everybody,
I appreciate it.
bye-bye. Take care.
Thank you.